market is hitting all-time highs, but I've been getting questions and comments, all of them asking the same painful question.
Sanika, the market has recovered, but why is my portfolio still bleeding and down?
And the answer, in most cases, is surprisingly simple. You did not buy bad companies, you bought good companies, but at the wrong price. So today, we are going to fix that problem. We are not just going to talk about good growth stocks available at reasonable price. We are going to talk about something far more powerful, a concept called growth at reasonable price, or GARP. Now, this is the framework that helps us find good growth stocks at a reasonable price. So I am going to show you how to use that framework by analyzing two very different companies on my radar. So how do we use this GARP and find the right time to buy a stock? Think of it like this. We are looking for a company that is not just a sprinter, but a marathon runner which is not overhyped by the crowd yet. So I ran a screener with some simple but powerful criteria. First is consistent growth. The sales and profit growing over 20% for the last 3 years. Second, improving profitability. Operating margin should be expanding. Third is a reasonable price. A PEG ratio below 1 which shows that the growth is not overpriced. Fourth is low debt. Debt to equity ratio should be below 1. Also manually, we will be looking at the PE ratio of the companies and comparing with its competitors. And the PE ratio should be either reasonable or below the industry level. So this screener gave me a list of interesting companies. But remember, the screener is just a map. You still have to go on the journey. So I did a deep dive on few of the companies, and the first company that we are looking at is a hospital chain in North India. Now this stock story is the kind investors dream of. It is a fast-growing multi-speciality hospital chain in a region which is desperate for quality healthcare. Now India has 16 hospital beds for every 10,000 people, and the world average is 33. So that gap is a multi-billion-dollar opportunity, and Yatharth is sprinting to fill it. Yes, the first stock that we are analyzing is Yatharth Hospitals, and its numbers are simply breathtaking. So over the last 5 years, its profit has grown at a staggering 152% CAGR, and in the last year alone, the revenue shot up 31% to over 8,800 crores, and they have nearly doubled their bed capacity in just 4 years, from 864 beds in FY 2021 to 1,605 operational beds in FY 2025, with a plan to hit 5,000 beds by 2030. Now their current hospital occupancy is at 61%, which is well below the industry standard of 75%, and the revenue per bed is also lower than its peers. But that is not a weakness. That is a massive untapped potential. And as the new hospitals mature, these numbers are set to climb, pouring fuel on an already roaring growth. So according to our GARP filter, this stock ticks for the growth point. You can clearly see the compounded sales growth is 32% in the last 3 years. Now what about the valuation? Is this stock expensive? Now see, the stock is trading at a PE of 43. A near 30% discount to its peers, and the PEG ratio is around 1.2, pushing slightly towards the overpriced zone. So here for the valuation also we are giving an okay tick. So the valuation is not cheap, but not too expensive to overlook the stock. So let's recap. High growth, huge untapped potential, debt-free balance sheet, and a discounted valuation. It feels like we have found the perfect stock, right? But stories that sound too good to be true always have a black spot. So when I looked closer, I found one important red flag due to our GARP system. The operating margins have fallen down from 32% to 24%, a consistent decline in the OPM percentage from the last few quarters. While this is happening due to expansion, this does not make Yatharth a bad company. In fact, it shows that the company is hungry to grow. The company has a low debt to equity ratio of 0.02, which is again a green tick for our GARP point, and the valuation is slightly concerning. As a result, I will not directly jump and buy the stock right now. I will buy after a time consolidation. Why? Because it did not pass our GARP test, slightly due to valuation and due to declining OPM percentage. So such a stock, even if it sustains a profit growth of 25 to 35% CAGR, has the potential to deliver 3x gains in the next 2 to 3 years. So this stock is on my radar, and this is how GARP helps you. The stock was not bad, but the timing to buy the stock was not good. Now let us look at our second company, a completely different story. And I like this stock because it always gives us a chance to build position in it before it rallies. But today, let us use GARP to check out this stock. So the stock name is Oberoi Realty, a premium real estate developer in the Mumbai region, building luxury homes, offices and malls that define the city's skyline. Now their numbers are not as explosive as Yatharth, but they are incredibly strong and steady. A 25% sales growth and 28% profit growth over the last 3 years. And the most loving part is that they have been improving their operating profit margins from 44% in 2022 to 59% in 2025, showing that they can manage their cost effectively. Now let us analyze the Q2 FY 2026 results. So the company delivered a strong top line performance with sales jumping 35% year on year to 1,779 crores, driven by robust housing demand and steady traction in premium projects like Sky City and 360 West. So the demand on ground remains solid. And the operating profits rose 25% year on year to 1,020 crores. But here's where the short-term pain showed up. Operating margins slipped by 500 basis points to 57%, largely due to execution-related cost in Thane's Jardin project. So this is not a structural issue. It is a project-specific short-term cycle which the company is already managing. Now the management has lined up multiple project launches with Gurgaon and Worli in the timeline, and the redevelopment projects have already been signed. So the growth visibility remains strong. So the first and second point in our GARP framework are ticked. The company is showing good growth and the operating profit margins are also expanding. Now for the valuation. Oberoi Realty is trading at a PE ratio of around 27, and its peers, Lodha and Godrej Properties, are trading at much higher, 35 and 40 PE respectively, and its PEG ratio is 0.97, which tells us that the valuation is well justified by its growth. So this is a classic GARP case, a leading player growing steadily with a valuation that is not just reasonable but attractive compared to its competitors. And the fourth point, debt to equity ratio, is very low at 0.18, which is very good for a real estate company. So that is the fourth tick to our GARP system. And yes, the stock is down about 35% from its all-time high and is consolidating. But for a long-term investor, this is where the opportunity lies. You are getting a premium company, not at a premium price, but a fair one. And the strong support lies near 1,525 rupees, and 1,798 is the key resistance to watch for the breakout. And with fundamentals holding firm, a meaningful pullback cannot be ruled out. So what have we learned today? We looked at two companies. First, a story of explosive growth which looked almost perfect but had a hidden red flag that demanded caution. And how did we find that red flag? Due to our GARP system. And the second stock is a story of steady, powerful growth from one of the leading players, and the stock is available at a price that makes sense. So this is the essence of GARP. It is not about chasing the highest growth numbers, it is about understanding the full story. So as always, if you have any questions about the GARP concept, let me know in the comments below. I will try to answer them. So this was Sanika from Rangavan Finance, and I will see you very soon in the next one. Till then, bye bye.